Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Tuesday, the 5th of September, Bull versus Bear webinar. Steve Miley here on the call for trade day. I'm back, guys. Hello. I've had my vacation. It was a very nice vacation. Kept abreast of what's been going on in the markets. It's been quite an exciting end to August. Markets in bull mode, but a little bit softer in here this morning. But yeah, it's all been good. I hope you guys have all been doing well. I trust you are trading. I trust you are doing well with your trading. And yeah, I hope everything's good. So we're going to go through our usual run through. A slight change of normally on a Tuesday, I would be doing my normal run through, but I'm going to do this as a pseudo Monday because obviously we had no webinar yesterday due to the US Labor Day holiday. So I hope you all guys in the US all had a great Labor Day long weekend. So we're going to kind of do the bigger picture run through of the week. I'll do a little bit of a recap of last week. And then I'll also take a look at obviously what's going on today and what to watch out for today. So let's take a look at a little bit belatedly because of the Labor Day weekend. We've got the macro matters is out, so you can get this in the trading room. I posted it also into the forums. So the macro matters and the weekly update, these are both out. So on the macro matters in here, focusing on actually a little bit of a focusing on El Nino. If you want to read up about that, it's a bit of a longer term outlook. We spoke about El Nino a few months ago, but just had a little bit of a focus on that. And also then basically there's been a shift in view that Fed less chance of another rate hike coming through, more chances of potential rate cuts. And so we're focusing on that, and that's sent us into a bit more of a risk on mode in here more recently, but tone is slightly softened in here. Also focusing on the non-farm payroll reports, which kind of really ease some pressure on the Fed in here with the headline NFP number 187 below the 200,000 level. But I think we're kind of with the numbers we've got coming through. I think we're in that Goldilocks scenario, not too hot, not too cold, just about right. We don't want the employment. We want the labour market to slightly loosen, right? We don't want a really tight labour market because that puts upward pressures on prices. So I think that we want decent numbers coming through to show that the labour market's okay, that the economy is still doing well, but equally that it's not going to contract. But equally, we don't want it too tight. That's going to put upward pressures on inflation. And I think we had that kind of what we got. We did get a surprise jump in the unemployment rate up to 3.8%. But that was partly driven by an increase in the participation rate. So and we've got a drop in average hourly earnings, which again is a positive, right? Because it means that less upward pressure on prices as well. So all of that is was a positive in here. And then we go on to talk about the US dollar and go on to talk about the ECB coming up in the next week. And then also then a little bit of a focus on the pound. And then in Asia, looking at the RBA, which we talked about likely remaining on pause. They did pause in here. And then the support from China on the fiscal side and the equity side, is it enough? So let's take a look at the weekly recap, though, for a little bit more of a focus in here of what we've got coming up in the week. Well, obviously, it was a holiday yesterday. We had very little out of Europe in here yesterday. RBA, we've had overnight, the Reserve Bank of Australia, they left rates unchanged as kind of anticipated. And now the market looking at the fact that the rate hiking cycle is likely to be over out of Australia. We've had these service sector now because of the US holiday. We've had all the European PMI and UK PMI data out today. You don't get the US data until tomorrow because it's a day later because of the holiday in here. But we have had the European and UK PMI. That's been a little bit disappointing. We'll come to that shortly. And then that means that the actual dollar has rallied in this. We're kind of in risk on. risk off, slight risk off mode in here, and the dollar's strengthening because it looks like US economy seems to be faring a lot better than certainly the European. You'd definitely say than the Chinese economy in here at the moment. So all of that is seeing a bid for the dollar, a strength in the dollar, and also that also the risk off mode that we're slightly in. The dollar is seen as a safe haven as well. So the dollar has been the notable move in here. We're also going to talk a little bit about yields as well. Going into this afternoon, factory orders is the focus. So if I skip now to the actual data in here, so you can see the RBA left rates unchanged. And you can see in here all this PMI data. We've had both the composite and service PMI data in here. If I actually just go back quickly to yesterday, did we get Chinese PMI? Yeah, we did. So the Chinese PMI data, that's what I thought. I saw the article on this. That's slightly disappointed yesterday as well, overnight last night. So Chinese data disappointed overnight last night. RBA left interest rates unchanged as expected. But then if we look at here in the French, German, Eurozone as a whole, all of this disappointing, worse than expected. The only kind of slight bright spot was the UK data was slightly better than expected. Okay, but overall European data worse than expected. The PMI data coming out this morning, and that's meant European indices slightly softer. They have had a slight rebound, but European equity indices slightly down. US futures dipping lower, and the dollar up on the back of that. Okay, looking into this afternoon, the focus is going to be on. We have at 10 o'clock Eastern time, durable goods and factory orders. So durable goods and factory orders data is the focus for this afternoon. This afternoon, sorry, for me, for this morning, for if you are in the US. 5 things you need to start your day in here. So Chinese service sector, sort of slowest months ago. This is the PMI data we're just mentioning it here. And the ongoing slowdown in China, the ongoing concerns in here that we see. Goldman optimism now face less of a chance UK. So Goldman's putting out more of an upbeat outlook that the less of a chance the US will go into recession in here. Back to the office, we're not really going to focus on that. The dollar surging higher, 6 months highs. Treasury yields pushing back higher. Okay, and we'll take a look at the Treasury yields shortly. Upping yield down in price, and stocks slightly dipping on the back of that this morning. So here we have futures forwards rising yields. Okay, let me jump to the yield chart in here. And you can see in here, yields in here, back here on Friday, we had a push back up after the employment report, a push notably back higher in yields. Yields have been tracking lower and equities have been going higher since about the middle to late part of September, since the 22nd. Look, yields going lower in here. Okay, and if I jump to the to Trader Rate in here, yields going lower, and here's the yield 10-year note. So price is going up, okay, since about here, again, 22nd of August, okay, we're seeing bond prices going up and yields going lower. And if we jump to then take a look at, what that's meant for stocks in here, that's obviously been, go and look at the daily on just like say the S&P in here, and from pretty much the same time in here. So where we are, between the 18th and the 25th, so it was the 22nd was the day, it's this day here. Stocks have been tracking higher. We've had this rebound in stocks really, but then as you see in here, yields pushing back in here. Where's the yield chart again? Let me jump back to that. Yields in here since Friday been pushing higher overnight in here, and higher again this morning. So higher during the partial day in here on the and here yesterday, and higher again this morning. And that higher yield pressure, and I think what we really need to do is watch this area here. So in yield terms, is 425 and then 429. Okay, 425 and 429 on the 10-year. And if I go back to the where are we in here? Go back to the bond chart in here. If you're looking at the bond chart, it's down here. It's at 109, 28.5, and then 109.18.5. Those are going to be key levels. If we start breaking below these, watch out on the stock side. I know most of you are not trading bonds in here, but the bond market is certainly the kind of the dog that's wagging the tail at the moment. Okay, so I'd definitely be watching out for those levels on bonds, because if we break down through there, what it's likely to see going back to the stock indices is stock indices pushing back lower. So last week we pushed back above this 13-period EMA. We're holding above that at the moment. This is on the S&P. That's coming in around 44.86 in here. Well, actually, I can tell you exactly what it is, 44.86 and a half. If we get back below there, that could be a little bit worrying. If we take a look at the Nasdaq again, we push back above that. We push back above this swing high in here. That 13 period EMA is 15, basically 15,330. Down through there, it looks a little bit wobbly in here. So watching out for those levels both on the bonds and on the stock indices. I'm still, underlying pressures are still bullish in here, but we are having this dip in here this morning because we've shifted into risk off. And why have we shifted into risk off? It's because of this disappointing PMI data. And as we said previously, if we go and take a look at the dollar's been the main reactor to all of this. And if you see in here, go and look at the dollar index. Dollar index has been pushing higher from last week anyway, and then surging high this morning. It really is the big winner in here this morning. It's been the big move overnight, and this is because more to do with Eurozone weakness. So remember, over 50% of the dollar index is made up of the euro versus the dollar. So this is really euro weakness as much as it's dollar strength, okay? Euro going down versus the dollar, and therefore the dollar index going up as a Eurozone. Certainly looks like an underperformance in here versus the US economy. Right, let's go back to the headlines. We will come back to the chart. So, all the same thing here. Futures for Chinese service data waves. We looked at the Chinese service data from overnight. We looked at those rising yields in here. Stocks retreat, dollar rises as risk off deepens. And here, euro slips to nearly 3-month low versus the dollar after the PMIs. Again, the PMIs. Chinese country has paid coupons, so that's a slight positive in here. China's Country Guard is a development. It's a housing development company in here, so that's a positive in here that they've actually paid coupons on 2 of its dollar bonds in here. Global business splutters. Again, this is talking about the PMI data. Dollar surges. We kind of covered that. All the same stuff. Eurozone August downturn deeper than was thought. That's the PMI data. UK PMI survey shows sharpest business slowdown in 7 months. So even though that the UK data was actually better, sharpest slowdown in 7 months in here from the UK. ECB says consumer inflation expectations edged up in July. So this is at the ECB as well. That's not good either. That's a negative. Okay, inflationary pressures still edging back higher. We've spoken about the RBA leaving rates unchanged, and dollar again surging to 5-month high. US economy powers. So this is the relative. The dollar US economy doing relatively better, but we've still got that PMI data to come. But remember, not till tomorrow for the US. And oil slips from its high since December. So oil has been doing well. It's been back in risk on over the last week. Jump back into the oil chart in here. See the oil chart in here. Oil's been doing really, really well in here as we've been in risk on environment, but yesterday and then again in here this morning down as we've shifted slightly back to risk off. Again in here, I think these slight risk off shifts that we've seen in here over this morning, overnight and this morning, Asia through European sessions, I think they're buy opportunities for oil, buy opportunities for stocks in here, but just be wary. I think really critical. You got to watch that yield, those yields. Watch the yield, watch the price on the 10-year future, watch the yields on the cash market. If we start breaking those levels that I just went through there, then I think on the downside on price, on the upside on yields, then it could have a negative effect onto the risk environment, and so you could see a shift back into more of a risk off scenario. What else do I have? I think I've got most of through the stuff in here. There's the yield chart. Just to point out, and we're a little ways off of this at the moment, but we do have the Fed. So ECB in play next week. Okay, that's the week commencing the 11th. The week commencing the 18th. So here you can see the Fed are in play. The meeting is 19th, 20th. We get the announcement on the Wednesday on the 20th. Remember, the Fed blackout period is the week and a half before that, and it kicks in on the Saturday. That's this Saturday coming. So this week is the last week of Fed speakers. So just watching out for Fed speakers throughout this week. Any Fed speakers are going to be watched with note because it's going to be the last Fed speakers we get until up until Friday. Ahead of the actual rate decision. On actual talking about the decision in here, pretty much very little chance of a rate change in here at the next meeting, the September meeting. You can see in here 93% chance that we stay as unchanged. But if we go to November now, this has definitely been rising. Okay, now a 40% chance of a rate hike in November. And if we go to by year end, we're still really looking for potential for rates to be higher. The betting is really that we're going to be remains unchanged, but there is risk that rates are going to be higher going into year end. And we're now not probably looking for a rate cut. If we go to the March meeting in here, there's unchanged. This column in here is the unchanged column. So there is a chance in here, what's this, about 35, 36% chance in here, 36, 37% chance of a rate cut. But there's also 19% chance that we're going to be higher in rates come March. By May, though, it's pretty much nailed on that we're going to be lower in rates in here. So you've got, what's this, 36, 46, 53, 55, 56% something in here chance of us being lower in rates by May. But that's a long way out, right? Okay, what else do I have for you? So looking at the overnights in here, Asia, you can see we're notably lower on the Hang Seng overnight. Nikkei was little changed. European exchanges, they were lower than this. We've actually dipped and rebounded, but about between 1 and 2 tenths lower on the German DAX, 3 tenths lower on the French CAC, and the FTSE, the UK index is actually up. But they have dipped and rebounded. And you can see in here, if I actually open this up, in here on the futures overnight, where is it? So we are slightly lower, but not too much lower in here, about 2 tenths on the S&P, 4 tenths on the Nasdaq. So not really, I'm not going to go too much detail in here on the charts in here. I think the key thing to watch really is those. I mean, I'm still kind of underlying bullish. I mean, we pointed out the 13 period EMA in here. I think down below really that 13 period EMAs that we've already run through, or below this little low here. So this is on the S&P. Down below, actually, let me just go across to the intraday chart, but down through here it look a little bit wobbly, I think. So that's just below really, so 44.96 and a quarter. Down below there it looks a little bit wobbly, but otherwise looking for potential to be back to the highs in here. Maybe looking at this little down counter trend line we have off the top in here, monitoring that going into today. Okay, and then on the Nasdaq it's kind of similar. So if we go to the 30-minute chart on the Nasdaq, this low over here is really going to be the key low on the Nasdaq. That is down at 15,361. I think we said 330, right, for the 13-period EMA. So 361 in here. And again, I'd be looking at this little counter trend line in here off the top and looking for us to get back above that to reinstate the more bullish tone. So yeah, and without much data, I think, the underlying, we've had this dip lower because the Europe's not been that great. The underlying bullish tone that we have that's come from the last week or so, looking for that to resurrect as we go into the US Open from my side. Okay, that's all I have for you guys. Great to be back with you. Any questions before I wrap up? No questions? Okay, cool. I'm going to wrap it up there. Then I'm going to wish you all a great trading day as ever. Take care, stay safe, and I'll be back with you with another Bull versus Bear webinar tomorrow. Cheers, guys. Bye.